Hello and welcome to CMC Markets weekly trading outlook for the week of December the 15th, 2014. My name is Colin Szynski, Chief Market Strategist. Our topic for this week is the Fed Hawks' last stand. The main event this week is going to be the last U.S. Fed meeting of the year, with results coming out on Wednesday afternoon. There's been over the course of the last year, we've seen the Fed tapering, and they've ended their QE3 program, and they're starting to move towards raising interest rates. But on the one hand, while they've been doing things that have been leaning towards tightening, they've been very dovish still in their language, and in particularly these comments related to an extended time period between the end of QE and the beginning of interest rate increases. Now, as we go into this Fed meeting, we have three of the regional Fed presidents that rotate every year are on their last meeting of voting, and three of them are hawks. That's Dr. Plosser, Dr. Fisher, and Dr. Mester. Those three are three of the most hawkish members of the Fed. They're about to rotate off, and the other member is Dr. Kosher Lakota, who is actually one of the dovish members of the Fed. So those four are about to rotate off and be replaced by four other presidents. So for the Fed hawks, this is really their last big opportunity to really push the Fed into a more hawkish stance before they rotate off and other people take over. So this could be a very significant meeting. In terms of what comes out, and people will be focusing on a few things. First of all, will be, do they change the considerable time language? Some members have said no, we're not going to. Some have said yes, we should, and some have said in light of the recent strong U.S. economic data, including the absolutely spectacular non-farm payrolls above 300,000, the big jump in November retail sales, and other major indicators, that the Fed, perhaps it's time for them to start looking more hawkish. Most people are still looking for the Fed to start raising interest rates in June of 2015. Perhaps that gets moved up to March. If you're going to see the Fed move sooner, something you should watch for is what happens in the member projections. Do the members start increasing their GDP projections, for example? That could be the precursor to a sooner interest rate hike. Or we also watch for what are their targets for the end of 2015 in terms of interest rate hikes. If those targets start to move up, it means either they're thinking that the Fed could start raising rates sooner, or that the Fed may start raising rates at the same time, but do it more aggressively. There's been a lot of talk about that too. Do they do a couple of small increases and then wait a while and see what happens, or do they just start on a consistent path? So we'll wait and see. There's a lot of moving pieces at the Fed. Some of this may start to shake out in the coming week. And why is this important? Because we're now starting to see that the potential for a bigger correction in stock markets. Funny enough, it's amazing what a week has done. I was sitting here a week ago, and we were talking about how the DAX was way up above 10,000, and how could it possibly be there, and the Dow being way up where it is, and how could it be there with the prospect of a more hawkish Fed? And, well, now this week we started to see things correct again, and in a lot of ways the liquidity effect is starting to take hold. I've done a study on week by week what happened to stock markets after the end of QE1 and QE2. The most dangerous period, or the most high-risk period for stock indices, was weeks 4 to 7 after the end of the QE programs 1 and 2. We've gone so far this week. I'm talking today on December the 12th. It's the end of week 6. And what have we seen? Weeks 4 and weeks 5 saw continued gains in stock markets. Week 6, we've actually seen a correction finally take hold that was due for some time. We may still see this correction spill over into next week, which would be week 7. And then I expect things to go quiet for the 2 holiday weeks. But we could still see volatile markets and trading opportunities in U.S. indices over the next week, not only because of everything else that's going on in the world, but just even because of the post QE3, we're in this in a riskier period for a liquidity crunch if we're going to get one. There's another one possibly towards the end of January that we'll revisit in the new year. So I'll start briefly here with just showing a bit on the client sentiment and what's driving this. Even though, as I said, the liquidity effect has finally started to take hold this week, but it's not the liquidity that's been getting the blame for the sell-off that we've seen this week. The blame has been firmly planted on the decline in crude oil, pulling down the energy sectors, and also on the political uncertainty in Greece, and the realization coming back that things aren't all well in the Eurozone, that a lot of things that have been pushed to the back burner over the last 2 years may find themselves back on the front burner in 2015. We've seen Treasury yields start to creep up, and and perhaps more pressure starting to come onto may come onto the ECB or on politicians to undertake the reforms or stimulus that they've been stalling on. So there's a lot of moving pieces in Europe as well, and also heading into the new week, we could see continued action in Asia Pacific markets and commodities, particularly with the week kicking off with the Japan election results. So there's a lot to cover and a lot going on. We could still see quite an active week for trading before we move into the holiday season. So I wanted to start with the big sell-off in crude oil, which has been the talk of the town all week, to see major support levels one after another get totally taken out. We've seen the $60 level for WTI get obliterated, and Brent get very close to its own test of $62. Just wanted to start here with to set the tone with a big chart here on West Texas crude, and this is a monthly chart dating back to 1997. So we've seen it here. We've got the 2008 crash. We've seen the recovery, and really, actually, funny, earlier this year, kind of a big double top for WTI. It's been going sideways, and now the bottom has fallen out, and we've seen it accelerating. Now, we are getting oversold on the monthly RSI, so at some point we may see a trading bounce, but it's important to remember that this could be a fairly significant, this is a very major decline in crude oil, and things are different. This isn't 2008 where we had a recession and we had a financial crisis and a major market crisis that pushed it down. The low in 2008 was down around $35, and people have been asking me where do I think crude oil could bottom out this time. I think $35 because of what happened is probably a little bit extreme, and I'd be hard pressed to see it getting there at least anytime soon. However, having broken 60, this big $50 psychological barrier here certainly could be tested, and we could see it go below it in some kind of a washout. I don't think we're at the final capitulation yet, and because of that, we could still see weakness in crude oil, even if we do get the occasional trading bounce. And what's intriguing about this is when we go back now and look at the client sentiment on West Texas crude, we've actually got it fairly mixed here. What's interesting is we've got, in terms of number of clients, we actually the number of clients are actually long, but we've actually seen in terms of position value, clients are net short, and in particular, we've seen a big surge today in top clients going short. So what does this mean? It means we've got a number of smaller people going long, and people that are putting in larger amounts of money are going short, and the people that have been profitable over the last few months have been going aggressively short on crude oil. And this is an issue that comes up with in trading these kind of markets, is not trying to catch a falling knife or on the bull market side, standing in front of a freight train. Right now you're into a situation where we're into a serious downtrend. You may get the occasional trading bounce here and there, but just because it's oversold doesn't mean it's necessarily done. It can get even more oversold. We've seen in the yen this year how markets can get very overextended on the RSI and stay that way for a while. So even though we may see continue to see volatility in the crude oil market, the basic trend is still downward at this point in time. This may continue to weigh on stocks. However, over the longer term, it's important to recognize that a drop in the crude oil prices tends to be very good for economies. It puts money back in people's pockets. It cuts companies' fuel costs. It frees up money for other things to happen. And big drops, crashes in the crude price in the past have been known to ignite a strong economic growth and big rallies long term in stock markets. So it is possible that once we get through this volatile phase here in through December and into the first part of 2015, things could be looking up for the stock markets for the longer term, but we still may be in a period of short-term pain before we see longer-term gain. It's a little early to say. However, also the volatility that we are getting does have the potential to create opportunity for short-term trading, but we need to recognize this environment for what it is. So, moving onward, I also wanted to talk a little bit about gold. We've had a nice solid rebound in gold this week, and while we've got clients going short on crude oil, we're actually seeing clients start to go long on gold. This could take take two sides. First of all, there's the good news in terms of the physical demand that India had gotten rid of its import requirement. That's helping to boost gold demand going into wedding season. The second thing is increased political uncertainty, particularly in Europe and related to the Eurozone, also seems to be helping to renew interest in gold, and general market volatility as well also appears to be helping to renew interest in gold. Finally, gold could benefit if the ECB does actually get serious about increasing its balance sheet. Just looking here briefly at the chart for gold, we'll see that gold had been in a pretty solid downtrend from July. It's broken out of this downtrend here. It's consolidating and is backing and filling and digesting this rally, but it's holding above the breakout point. The breakout point is 1210 with additional support down at the 1200 round number. The RSI is still in an uptrend, even though it's leveled off a little bit, seeing some consolidation, but basically upward momentum is still building. We still have room to the upside in gold. This first resistance here is around 1230, and this up here is in and around 1250. So we could see gold start to moving up in a bit of a step pattern where you get a rally, consolidated a higher level, rally, consolidated a higher level, nice downtrend break here, and this old resistance line has so far emerged as new support. So the basic underlying trend for gold remains favorable. I'll take a look now at a couple of indices. First, I just wanted to show something on the client sentiment that was quite interesting here. And that is if we compare the U.S. and Germany. Both the U.S. 30 and the Germany 30 hit new all-time highs last week. They've both come off, but how clients have reacted to this is very interesting here. We're seeing that clients are still net short on the U.S. market. It looks as though there has been a little bit of short covering with some of the short positions coming back off a little bit as the market comes down. Some clients are taking profit on their short positions, but overall, people still are taking a cautious approach toward the U.S. In the case of Germany, on the other hand, clients have gone very aggressively long. Not only they covered their shorts, but they're generally long. And this is something we have to watch out for because people are still clearly speculating that the ECB is going to come in with some kind of super stimulus in January. To date, they really have not done much. Now, the LTRO auction that last in the week ending was basically came in line with expectations, but they had expected to use those to put 400 billion back into the system. It was 200 and a bit, a small bit, and 212 I believe it was. So it wasn't very much. It was about half of what they were expecting. So this means that they may need to come in really aggressively if they want people to take them seriously, because they've been talking about this for 6 months, and really it's been all talk and no action to this point in time. So we'll see if that changes. Who knows? But what we'll be looking at, and what could in particular affect the Germany 30 this week, is the flash purchasing managers indices. They're coming out for Germany and France. We'll get another feeling now as we're moving into December. How are their economies doing? Are they continuing to slow? Does that put even more pressure on the ECB to actually do something? U.S. markets this week, primary focus on the Fed meeting. If we see any kind of movement where they pull towards pulling forward or getting more aggressive about raising interest rates, could be bearish for stocks. So because we've had such a big run up from stimulus, any kind of move away from stimulus it could be seen still as still bullish for the U.S. dollar and potentially bearish for stocks in the short term. In the longer term, it does reflect a growing economy. It's good. It can be good for stocks. But in the short term, as we move through this transition from the end of QE to the beginning of interest rates, it can cause volatility in stock prices. And as I said, because QE has pushed up prices so much, they remain vulnerable to a liquidity correction, which we could see play out this year. We could see play it out in January or sometime in the early part of 2015. But for the next few months, we may still get some shorter-term volatility in the U.S. markets. So I'll just highlight the charts now for the U.S. 30 and the Germany 30. We'll start with the U.S. 30 here. And as we've seen, a big rally up off this bottom here. Then we saw upward momentum kind of starting to slow and then rolling, and then the bottom falls out. And particularly after we broke the short-term trend line here, retest as new resistance, and then kaboom. And we've seen it go down now. This was pretty much at 18,000. Dow was very overbought. It's since rolled under 50. That's confirming that momentum is turning increasingly downward. We've had the taken out this 23% retracement, and we're working our way lower here, down around 17,400. This is the 50-day moving average here, around 17,300, and the 38% retracement in and around 17,190. So there are some support support levels in for the Dow. Looking at the DAX, the Germany 30. We'll just bring this one up as well. And we'll see here the same sort of thing. Had a good move up, midway consolidation, another big move up. 10,100 failed out last week. It started going down, and then and now we've seen the pressure increasing on it. Again, the RSI has now, it was overbought and very vulnerable. RSI has taken out 50 to signal the downward turn in momentum. We've taken out the 23% retracement. This is 96.85, testing another old Fibonacci level here at 95.85. Round number support in the 50-day closer to 9,500, and another Fibonacci here in and around 94.25. So still some room for some retrenchment possibly on the DAX. While we're looking at North America and Europe, I just wanted to briefly highlight the Canadian market. Canadian stocks are vulnerable here, having because of their higher exposure to the energy sector. But we've seen it get pretty slammed now, and we are seeing it get down where it's starting to get oversold. We could yet see the retest of this October lows in the 780 to 790 range for the Canada 60. We're just above 800 now. I also wanted to highlight briefly, I mentioned the flash purchasing managers numbers. In addition to the looking at them for Europe, traders will also be looking closely at what comes out from China. China's economic data of late has been very mixed. Chinese markets have been very active, and the slowdown from China is one of the things that's been impacting energy prices and metals prices in commodities in general, with the coming under pressure on the fear of lower resource demand. And the problem with crude oil is that we've had this lower demand coming in at a time where supply has been increasing and nobody wants to be the first one to cut. We're in a market share war, and people are worried that if they cut, somebody else would just step in and fill the vacuum and leave them with a smaller market share. So while people will still be keeping an eye closely on China to see, is it stabilizing, is it turning? Also with Japan this week could be quite active. We see the week kicks off with the results of the Japanese election, the vote on whether to continue Prime Minister Abe's mandate and give him an increased mandate for more change, for more stimulus, or not. We'll see what comes out of this. But certainly that could have an impact on a number of markets right around around Asia Pacific. So I'm going to start here with the China A, which has been extremely active lately. And this had had an explosive rally. It was going totally parabolic, getting very overbought, and we saw it spike up above 10,000 and then just get knocked back down again, basically falling under its own weight. It is leveling off here. We may still see it bounce around here, but this is pretty much a 9,200 to 10,000 trading channel. This level here is just above 9,600, in and around the middle. So we could still see some room for volatility and room for swing trading in the China A. If we look at the Hong Kong, where we've now been range bound for quite some time. Actually, we're starting to see it actually start to break this. The bottom of this was 23,230. This was 24,360. We're actually starting to slip below the bottom of this a little bit. The next Fibonacci level in the retracement is around 22,720, and this here is the 23,000 round number. We're seeing some weakening in the RSI as well. So it looks as though people are concerned about the health of the Chinese economy. We could see these indices continue to drift back. Looking now at the Japan 225, which could be quite volatile around the election results. We've seen it. It has been spiking up. Particularly, there was a big run here when the Bank of Japan brought in new stimulus, and we've had a good run up again. We ran into resistance above 18,000, just like with the Dow. It got a little farther, 100 odd points farther, and now it started to slump back as well. Has done a 23% retracement back to 17,200. It's holding 17,000, but if that fails, the next old support level 16,870, and the next Fibonacci level 16,660. RSI is leveling off here about 50, basically keeping the underlying uptrend intact. I just wanted to, I'll also just briefly show here the Australia 200. We're seeing it's been under a lot of pressure lately, particularly with the concerns about the slowing Chinese economy and fallen resource demands. One of the reasons China's been under pressure, there's been a lot of rumors and speculation going around that they could be ready to cut their 2015 growth forecast from 7.5 down to 7. If that's the case, that's been weighing on resource prices, may continue to weigh on Chinese and resource indices. We're seeing the Australian index coming down here. This is a cluster of Fibonacci in and around 52.75. That's been broken. Next Fibonacci support in and around 51.40. The October low down around 5100, and we're just at 5180. So we can't rule out that we may retest this support zone in here, particularly if any data from China or news comes out reflecting a weakening economy. And I just wanted to wrap up quickly with a couple of currency notes. First of all, I'm going to do with the fall in crude oil, we have seen weakness in the Canadian dollar, and just wanted to highlight that briefly. We'll use CAD US dollar here to show the breakdown, which is pretty substantial. Since July, it's been in a downtrend. We've seen it here break down through 86.80. This on the US dollar CAD was a breakout over $1.15. We're seeing the CAD continue to break down here. And as long as we see oil remain in the downtrend, the Canadian dollar remains vulnerable as well. The euro could also be quite active this week. We'll look at briefly here at euro dollar. If we get a ongoing feeling that all through the 6 months starting in May of the talk of stimulus, even though it's been all talk and little action, has really driven down the euro. However, if we look here, we've got lower lows in the euro, we've got higher lows in the RSI. This is a pretty big positive divergence coming in. If the ECB, people get the idea that the ECB is not going to come through on big stimulus the way that they've been speculating, there is potential room for a rebound. First resistance 125. It's trying to bust this short-term downtrend here. Next resistance 126, and the Fibonacci level near 126.90. Another signal that the euro is starting to turn around would be if it finally gets back above and holds above the 50 level on the RSI. That would signal an upturn of momentum. So there is potential for a rebound in the euro, but you got to be careful with that one, because if the ECB does suddenly wake up and decide to deliver on their promises, then you could see weakness. But at this point, I think there's been quite a bit more stimulus priced into the euro than we've seen to date, so that there is potential for a trading rebound in that one. There's a lot of things going on clearly in the markets. We're looking for a very active week for the week of the 15th. The following 2 weeks, the weeks of the 22nd and 29th, are the holiday weeks. We're looking for things to be pretty quiet. On that basis, we won't be doing videos for those 2 weeks. We'll be putting out our next video. Will come out on Friday, January the 2nd, in time for the week of the 5th, which will be the week of the first week back to trading, and the first week with all the new data coming out for the month, purchasing managers, employment, and so on. So we're looking for, by that point, it'll be a busy week again to start the year. So at this point, we want to wish everyone a Merry Christmas and a Happy Holidays and a Happy New Year.